Welcome to month one of the dual momentum system. In this video, I'm going to look at the initial selections for the system and why I bought them. So the aim is to build a momentum portfolio by finding strong performing sectors, factors, themes, countries, and asset classes. I'm going to benchmark against the S&P 500 because it has a strong currency behind it, US dollar, and it has entry criteria for inclusion around profitability. So it's a good basket of companies. I'm looking for low correlation to the S&P 500 so that when we read about a US recession, we aren't really that bothered. And I'm looking to diarise reasons for the trades to help improve my learnings, which is so important on our investing journey. So disclaimer, this is a study of momentum and trend investing. No specific advice is implied. Find investments that meet your own risk and return criteria. And there's a methodology video. I'll post a link in the description and you can watch that to help understand the system more. So the hypothesis is that if something's got a relative strength of over 80, it should have a strong positive trend and hopefully be a leader of the future. Between 80 and 20, there's no real trend. There's a possibility of overhead supply where people have bought at higher prices in the past and they're now looking to potentially sell when they're back at break even. And if the relative strength is less than 20, then it's got a negative trend, might fall even further. But please note that some things at the bottom here might be deep value bargains and they might actually recover. And then some things that are at the top might just be bubble thematic funds and they're about to reverse direction, mean reversion back to what historic growth rate would be. So first up is country and region ETFs. So here are some that are currently performing well on a 6-month momentum basis, but we really need to screen out some countries that we're just not really interested in, because what we're looking to do is hold the investment through a cycle and be able to put up with the extent of the drawdown. So we've got like 14% here and the duration of the drawdown as well. So when we look at Turkey, 44% loss you could potentially see lasting for 609 days. So that's just really horrible. And although it's had some good growth in the last 6 months, and there's a certain person on YouTube that has it in his momentum system, the Sharpe ratio is awful and that the returns really aren't that good. It's just recovery back to near a new high. Indonesia, quite interesting, but yeah, metrics not that good. Latin America, a bit too heavy on commodities. So the pick here is India, where drawdown's pretty low, the returns are good, and so this returns over maximum drawdown is looking nice and healthy, and correlation to S&P 500 is 0.59. So quite high, but yeah, not bad. So that's the first one. Next up, I look at some factor ETFs, and here, yeah, varying returns, but actually the S&P 500 beats all of the factors, because when they start to add in like Europe and Japan, then the returns go down. So you have to wonder, well, if the aim is to beat the S&P 500, this isn't really going to cut it. And what really shocked me was these very high correlations here. So basically, all these ETFs, they're fishing in the same pond. So they're taking the largest companies in the world and then finding a subset of that around certain factors. But they're still keeping some of the sector weightings and the country weightings. So they're a bit anchored to things like the S&P 500 and things like just a global tracker. I suppose the exception is small cap, but that's probably one of the worst performers here. Minimum volatility is doing well at the moment, but actually its longer term stats aren't that good. So I think that this would be too dependent on market timing, that you'd continually be switching factors, but it's quite difficult to really optimize that, and you'd be buying a factor when it was doing well, and then you might find in the next few months it just reverts back to the mean, so you could be buying at completely the wrong time. So there's no selection there. So momentum investing, it doesn't always work. So the worldwide momentum ETF, it doesn't work because it rebalances every 6 months, which is too long. It has over 300 holdings. Well, why don't you just pick like the best 50? It has quotas around certain sectors and countries that tie it too much. And it worked well in 2019 when it held technology companies, but since then it's gone a bit off the boil. So next up, we're looking at sectors, and we're not looking at all of the sectors in the S&P 500. There's 11 in total, because that could mean too much chopping and changing between different sectors. And what we're seeing here is, I really like the healthcare sector, great returns over maximum drawdown, pretty good Sharpe ratio, because the drawdown is pretty shallow. It's on a par with something like utilities, but utilities has lower growth, and the duration of the drawdown isn't very long. So we can see some robust demand around healthcare from governments and insurance companies, and that's our selection. And there, people do these sector selector portfolios. The problem is that sometimes one sector really dominates and then it works really well, but other times the returns are quite correlated, they're quite heavily linked, and so you don't really pick a winner and you're just chopping and changing between very similar things. My second favorite one is consumer staples, and I think that might do okay in the near term. So we're really looking to invest in megatrends, and in my wonderful diagram, here is the megatrend, this huge thing here, and then here is the news, which is really just noise, and the news can't really attack the megatrend because megatrends just aren't impacted by a change in interest rates or someone's budget, or it's something that's so powerful and so new that things like smartphones and cloud storage have really revolutionized the world. Although I feel at the moment they're coming to an end and we need to pick new mega trends. But if you can find something that's powerful enough, it's kind of independent of any news. And then you don't need to read the news, you need to read up on mega trends and how they're changing the world. So if you invest in companies, here's a tiny little company, and it might be a value company with a declining market, no moat, low margins, high debts, massively leveraged to the news. So something like International Airlines Group was £7 year 2000, now it's £1. What a bargain. No, what a disaster. So things like this is a much bigger box now: news, interest rates, recession, higher input costs. These all dominate this poor company that just has to accept it. So we want to avoid that. So current mega trends, possibly aging population and healthcare provision in emerging markets, alternatives to high-priced oil and gas from Russia, which is clean energy, shifting economic power away from China, and there's a possibility that India could benefit here. I was just reading how some iPhone production might be shifting to India. Battery technology, particularly for cars, but I don't think we're really there yet. Artificial intelligence to really solve problems. Not quite sure who the winners are on that one. And there's a possibility of a commodity super cycle. So next up, thematic ETF. So this is how I'm trying to look for mega trends. And clean energy, phenomenal returns, has been very volatile, but the ETF essentially blew up and it got reconstituted. There's a video on that. I'll post a link to it. And I think that the newly constituted ETF is better and is worth considering. Second best one with a really good return over maximum drawdown is the battery value chain, but that's fairly weak at the moment, and when that sees more momentum, then that one might be worth considering. So professionals versus amateurs in terms of investors. Amateurs look at the past, the historic dividend yield, etc., but professionals look at the future, So for a property company, they'd see falling rates, increasing vacancy rate, higher interest rates. So amateurs rush to buy, professionals let the trade come to them, and then they scale into the position. So be aware of that if you're bottom fishing at the moment. So asset class ETF. So here's our property. Pretty awful stats, so we're not going for that. NASDAQ over a longer time frame, yeah, it looks pretty good, but actually commodities, fairly low drawdown and good growth. So yeah, that's got some good stats, and it's not that highly correlated to the S&P 500. And I used to like this iTips inflation protected bonds, but I've realized that actually the growth is all down to the strength of the US dollar. And so in the underlying currency, there's actually no growth there at all. So if the pound strengthens against the dollar, this will all evaporate and it'll all end in tears. So for the purchases, I'm going to do it close on Monday, the 3rd of October. India, healthcare, clean energy, commodities. For the moment, I'm going to keep a bit of powder dry and have some cash. And then here is the whole system. So it's a Google Sheet, automatically updates the prices on like a 15-minute delay, but I don't need to do anything. This just runs for me. And green is stuff I should look at a bit more, and red is stuff I should potentially look to avoid. And then I put it all into, this is the correlations file. So I look at the overall Sharpe ratio over 1, that's pretty good. The correlations here against, well, they're not that correlated with each other. They're not that correlated with the S&P 500 either. And when I put together the portfolio and then compare it against the S&P 500, so recently quite a lot of strength because that's what I'm selecting on, this 6-month momentum. This is clean energy blowing up. And yeah, I mean, historically not so good because you should have been in things like technology and not in commodities. But because I'm taking the shorter term view on momentum, it's more this bit that I'm looking at. And yeah, it's looking pretty good. So coming back to here, just as a wrap up, develop your own style. And there are files available. I'll put a link in the description as to how you can get hold of them. They're customizable because they're spreadsheets. If you love spreadsheets, you'll love the files. I'm on Twitter, so you can retweet my video on there. If you subscribe, you'll be alerted to new videos, and the next one on this will be up in a month's time, and there'll be a new video in a week's time. And like and comment, and see you soon.